Hello friends, last week in my video, I told you that there was a possibility of bulls trying to squeeze the bears out of their short positions because of a variety of reasons. Number one, you had the end of September, which is a quarter ending, and mutual funds tend to buy towards that quarter ending. But this kind of edge that the bulls had, a slight edge that the bulls had, I gave you a couple of caveats. And this is what I said in last week's video. A short squeeze can push markets higher. It can cause a temporary rally, but it takes follow-up buying to continue to push the markets higher and maintain the trajectory upwards. So follow-up buying is very, very important. So in the 4 days ahead, trading days ahead of you, please monitor the advance decline ratio, monitor the traded volumes, the ticket size per trade, MWPL, and the churn ratio. You know how to do it. I've discussed it in this video. A word of caution here. You do remember I have talked to you about how the two indices, the Nifty and the Bank Nifty, are like two wheels in a bicycle. Take a look at what's in the graphic above. You can't have one wheel broken or one wheel going clockwise, the other going counterclockwise. That's the surest signal of the bicycle toppling. Now, if the Bank Nifty and the Nifty do not move in tandem and the banking and financial sector stocks command a 32.6% weightage in the Nifty itself, please convince me, because I believe in statistics and mathematics. Please convince me mathematically how I should feel confident about this rally being robust. Yes, it will continue on short covering. I'm not saying it won't. But how is it robust? It's not a robust rally. It's because bears are covering their shorts. What happens after they are finished covering their shorts? That is what I'm getting at. So, in this week's video, I want to discuss with you what your strategy of investing and trading should be in times of war. Now, don't skip the last segment of this video. As you know, this video is divided into chapters, and don't skip the last chapter of this video wherein I give you my weekly trading strategy. I've coupled the wartime trading and investment strategy very briefly into it. So let's go and watch this video together. Now, starting with our usual weekly market roundup window on your screen now is the roundup window, and you can see that both the indices, headline indices, fell almost uniformly. Now, out of the 4 trading weeks that we had last week, because of Gandhi Jayanti, there was one holiday, both the indices fell on all 4 trading sessions. Now, that underscores the underlying bearishness in the sentiment. The US dollar index, the Dixie, went up a whopping a level of 102.49. Now that basically unnerved emerging markets, including India. And in spite of the fact that the US dollar was strong, which should have had a weakening impact on commodities, but so much was the nervousness and the tendency towards safe haven buying that gold and silver rose. In crude oil prices jumped by 11.5%. We'll come to it in a little bit. And the USD INR, which is the United States dollar versus the Indian rupee, gained 24 basis points and crossed 84 levels. This is in spite of the fact that Indian forex reserves are now at lifetime highs in excess of US dollar 700 billion. The Indian 10-year benchmark bond yield jumped 7 basis points, which is the bond prices eased a little. And that had a direct bearing on banking stocks, because banks are the biggest buyers of bonds, and the fall in bond prices impacts the mark-to-market situation. NSE market capitalization fell a whopping 3.5%. That means the sell-off was fairly uniform. Market-wide position limits went up a little under 6%, which is routine after expiry. US headline indices rose uniformly, and that provided tailwinds to our domestic markets. Friends, I now come to the ratio chart of the Bank Nifty versus the Nifty 50. And as you can see this weekly chart on your screen, There was a very feeble attempt by the Bank Nifty to kind of claw higher where the ratio is concerned, but it was still unable to. So we are still below the 2.3 to 2.5 levels, which would be optimal before we can say that the markets have the strength, have the gumption to basically go up higher from here. Friends, for those of you who came in late, why am I dwelling upon the Nifty and the Bank Nifty ratio, and why is it that why am I dwelling upon the banking and financial sector stocks? Look at the metrics here on your screen. You are seeing that financial sector services, both the banks and non-banking financial sector services stocks, command a whopping 3.60% weightage, which very clearly means without a rally in banking and financial sector stocks, there can be no rally in the broader markets. Forget about it. So this sector becomes the swing sector and holds the key to all future uptrends. Do keep watching the ratio between the Bank Nifty and the Nifty chart, please. Now, friends, I come to our in-house indicators. I start with the MWPL. Those of you who missed out on what the MWPL is, how important it really is, there is a dedicated video up here. All the videos that I want you to see are in the hyperlink below this video in the description, as well as in the pinned comment below. Now, friends, take a look at the weekly MWPL chart on your screen. After making a lower post-expiry low, I correct myself, at 31.37 as compared to the prior month's expiry at 31.92, the MWPL has risen again. Now, while that is routine, do note how at 37.21, the MWPL has gained the lowest amount in the comparable post-expiry week of 3 months. So, the sum and substance that I take away from this MWPL chart is that overall risk appetite may remain undamaged and kind of intact, but there is definitely a mild amount of caution. I don't really blame anyone. These are markets near all-time highs, and you have a war that threatens to escalate. Now let's go over to the next metric, the stock and index futures turnover. This is a total of all trading sessions during the week, and you have 3 concurrent expiries, which is October, November and December. Do note how there is a big spike every 4 weeks. Now this is the expiry week. When traders close their expiring month exposure and roll this over to the next month, it results in dual turnover being logged. And invariably after expiry is done and dusted, the turnover falls down again. Now what is noteworthy here is that the post-expiry turnover, in spite of the fact that this was a shorter trading week comprising of 4 sessions, the turnover is not at multi-week lows. That tells you that people were actually participating in the selling. Smart money was participating in the weakness and selling stocks. Now, friends, for the advanced decline ratio, which after the price itself is the most leading indicator of which way the trends are going. Do note how the Nifty has surrendered a little under 4.5%, which is a 20-week highest decline covered by this chart. And the advanced decline ratio, which is the average of all 4 trading sessions of last week, is at 0.7. Now, what it very clearly means is that for every 100 losers, there were only 70 gainers. Now, bulls need to do a whole lot better than that if the market is to go up. 0.70 is not an advanced decline ratio where I would want to bet my money on the bulls. And watch this ratio in real time on a daily basis, which I update on my social media accounts. My contact coordinates are in the fag end of this video, in the description below and in the pinned comment below. Do join our free WhatsApp and Telegram channels. I upload a whole lot of cool stuff every single day. Now, friends, I come to the basis. Now, the basis is nothing but the discount or premium prevalent in the futures compared to spot. Typically speaking, basis is highest in the week after expiry because traders have 4 clear weeks to play around with and therefore they are willing to pay a bigger premium. Now, look at what the basis has done. The Bank Nifty basis has actually gained last week. This is partly because of short covering and a little bit of value buying, whereas the Nifty 50 basis has come down a tad. You can barely notice it, but it has come down, which means at higher levels, there has been some long unwinding. But as long as the basis remains positive, which means the futures are trading at a premium to cash or spot, all is okay. There's still hope for the bulls to come back. I get worried only when the basis is inverted, which means futures are trading at a discount to spot. And basis like option premium tends to erode over time. It's a decaying asset. So in the coming weeks, I don't expect the basis to remain at these elevated levels. Now friends, I come to our in-house statistical indicator, the impetus, which measures the momentum or force behind each move. Note how both the indices fell almost uniformly last week. Now, while the Nifty impetus was lower, which means there was less of forceful selling on the Nifty, the Bank Nifty impetus actually went up. That means the decline in the Bank Nifty was accompanied by a bigger forceful sell-off. And I have been warning you that do note how in the ratio chart between the Bank Nifty versus the Bank Nifty was clearly underperforming the Nifty 50. And with a 32.6% weightage of banking and financial sector stocks, this sector can actually, the banking sector and financial interest rate sensitive sectors can actually drag the overall market lower, which is why we are basically looking at this data from multiple angles to get weight of evidence and confirmation of which way we should be trading. Now, I have compared these two indices like with two wheels of a bicycle. Take a look at this graphic above on your screen. Unless both the wheels of the bicycle are moving in the same direction, at the same speed, and both are intact, the bicycle is fine. The bicycle is the market. If you have one wheel going clockwise and the other going anti-clockwise, or one wheel is punctured or damaged, take a look at what happened up there. The bicycle or the market will topple. So both these indices and sectors better be going in unison or there is a threat to the rally. Now friends, I come to our in-house indicator, the lift, weight, thrust, drag indicator. You won't find this anywhere on the internet. And this is stood the test of time for almost 4 years now. Now look at how the Nifty has plumbed and lost 4.5%. And the lift, weight, thrust, drag indicator has also fallen, but it's still in the positive. So at 0.04, it's definitely a whole lot lower than 0.29, but still remains positive, which tells me that there will be some amount of fresh buying, but that fresh amount of buying will be very, very tiny. Can short covering come? Yes, short covering can come. And like I showed you in last week's video in the inset box, in that small picture-in-picture mode at the beginning of this video, short covering can take the markets higher temporarily, but they can't keep them there forever. It takes fresh buying. So ideally speaking, the LWTD and the index should be rising for me to go out there and buy afresh. The in-house indicators done, I now come to the bond markets. And as I have been telling you, this market is extremely sensitive and extremely important because it funds the price discovery mechanism of the other asset classes. Now, bond yields in the 10-year Indian benchmark bonds has typically come up, which means the bond prices have gone down. Now, with gains of 7 basis points, the bond yields are actually up 1% compared to the prior week. Those of my online family who have been fearing that they have missed the bus in their fixed income portfolio where gilt funds are concerned, please note, we haven't really missed the bus. At least that's not what I think so. Anytime you have any threat perception to equity markets here, you are going to see similar spikes in the Indian 10-year benchmark yields. which means there is always an evergreen possibility of catching on to gilt funds at plum mouth-watering yield rates with sovereign guarantee. Please bear with me. Friends, the bond market is done. I now come to the Bank Nifty, and as you can see on the daily chart on your screen, this index has fallen on all 4 trading sessions out of 4 sessions, and in the bargain lost 4.41%. It's closed below its month-long moving average, which itself is turning downwards, and it has also closed again within the bullish wedge which it had overcome. Now, since this sector commands 32.60% weightage, it means it also dragged the Nifty lower. Move to the weekly chart on your screen. Do remember what I told you last week about the Bank Nifty. I don't really like the inverted hammer that was made in the prior week. That worry that I expressed actually came about to fruition, and the Bank Nifty came down with a huge power candle, a bearish power candle. Even though the price has come down sharply, it still remains above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook remains positive as of now. A 6-month long moving average is currently placed at 50,700. It will change every day, but at more or less 50,700, I expect some amount of support to come in the near term. As long as bulls manage to defend 50,700 on a sustained closing basis, bullishness is still alive. But I would feel that the bull market has restarted only after the all-time high, which was clocked a fortnight ago at 54,467 levels, is overcome sustainably. Friends, in the week before last, this index was number 3 on the most volatile counters list as per our statistical beta rankings. In-house, it rose 1 notch to number 2, which means challenge level for an average retail trader went up. Last week, I advocated an estimated range between 55,400 on the upside and 52,250 on the downside, which was unfortunately violated downwards because the markets really fell slam dunk. Coming week, I expect an estimated range between 52,975 on the upside and 49,950 on the downside. In addition to these levels, please also watch the daily, weekly and monthly pivots that I upload for free on our free Telegram and WhatsApp channels. Friends, the Bank Nifty done. I now come to the Nifty 50, which, like the Bank Nifty itself, fell on all 4 out of 4 trading sessions last week, as the daily chart on your screen shows. It logged losses of 4.45% and it fell below its month-long moving average and closed below it comfortably. And the moving average itself largely remains upwards, but the tail end is slightly down. That's all right. There's a little bit of nervousness due to the fog of war. I would feel comfortable buying, or at least hope that bulls are coming back, only after the price starts trading sustainably above the moving average again. Let's take a look at the weekly chart on your screen. Note what I mentioned last week both in my video and or my Live Mint weekly column, which happens to be India's first and only media column and a free access media column that provides statistical inputs to its readers. Now, I told you last week that the bullish candles were getting smaller and smaller, which means the upward momentum was sagging. My second bone of contention and worry point was that the price, which I kept pointing out towards, was too far above the 25-week exponential moving average, which means there was always a possibility of a consolidation and or correction. When the price runs too far above or below the long-term moving average, there is a pull-push action and the price reverts back to the moving average. This is called mean reversion in statistical analysis. So my hypothesis is that if the Gaza war had not escalated, there would have been some other trigger which would have triggered a fall in our markets any which way. The missile attack by Iran on Israel happened to be the reason why the markets fell. But if it didn't, do note in the coming week, there are so many triggers. Number one, on 8th of October, you have elections you have results of the elections in Kashmir and Haryana. You also have on 9th of October, the RBI Monetary Policy Committee meeting, which will announce whether they are tweaking interest rates in India or not. Now, these are volatile triggers. So, markets could be any which way. So, there are a whole lot of other news aspects which could have taken the market lower. It's all a function of mean reversion because the price was too far above its 25-week exponential moving average. The fact that the price still remains above this moving average tells me that the medium-term outlook still remains positive for now because this is the average purchase price of an average bull. The average itself is currently poised at 24,200, and though it will change every day, but this is more or less the level which I will watch as a near-term support in the week ahead. As long as the bulls are able to manage to defend this support, I think all is well, and there is a possibility of an up move coming once there is clarity on de-escalation in the war in Gaza. But only a breakout above the all-time high is something that will give me enthusiasm to feel that bulls have absorbed all the overhead supply. Overhead supply is when trapped bulls are waiting in the wings to sell when their break-even cost comes. Now, till overhead supply is completely absorbed, a new bull market cannot begin. So, I want the all-time high in both the Bank Nifty and Nifty 50 to be overhead supply to be absorbed and fresh highs come again before we can see a new blue sky zone ahead. In the week before last, the Nifty was at number 10 on our statistical beta rankings of most volatile counters that we maintain in-house. Last week, it jumped 2 notches to number 8, which means challenge levels here also went up. Last week, I estimated a range between 26,775 on the upside and 25,600 on the downside. Unfortunately, like the Bank Nifty, this level was violated. In the coming week, I estimate a range between 25,625 on the upside and 24,400 on the downside. In addition to the targets that I mentioned, do watch the daily, weekly and monthly pivots on our free Telegram and WhatsApp channels that we upload every day. Friends, now I come to the retail risk appetite, which is the last bit of statistical analysis that I'll share with you before I go to my weekly trading strategy and wartime trading and investment strategy. Now take a look at the weekly chart on your screen. What you are seeing is the index futures, which are denoted as a blue line, have contributed 2 basis points higher, and this is the only gainer in the futures segment. Whereas the stock futures turnover contribution, which is indicated as a red line, actually fell by 47 basis points. Now, futures demand a lot more capital, are more volatile because the delta is higher than options. The fact that futures turnover fell sharply tells me that risk appetite was smaller. In the options segment, index options are the cheapest to trade where capital deployment is concerned. Their volatility is smaller. Their beta is a lot more quieter. The only gains in the turnover contribution in the 4 derivative segment last week came from index options, the least risky of all 4 segments. It contributed 133 basis points increased turnover, whereas stock options, which are a little more volatile than index options, contributed 86 basis points less compared to the previous week. So what I surmise from this is that risk appetite was really down last week. As a matter of fact, I'm seeing it at multi-month lows. I'm not finding fault with bulls. I was risk averse myself. My traded turnover fell very sharply, and this is exactly how I would trade in the week ahead. So now, friends, I come to my trading strategy as well as your wartime trading and investment strategy. I will continue to trade small for bigger price moves. I've explained that strategy in this video above. Hyperlinks are in the description and the pinned comment below. I would maintain a tail risk or hacienda hedges, which again is explained in this dedicated video on the subject. I will watch the MWPL, the churn ratio and the ticket size per trade ever so closely, which is again in this special video that I have recorded for my online family. So these are tools of the trade that you will be putting to good use in the weeks ahead. Where trading sectors is concerned, my focus will continue to remain on public sector undertakings, of which within that public sector undertaking umbrella, they will be in public sector banks, PSBs, OMCs, oil marketing companies, energy and power stocks, defense stocks, and interest rate sensitives. You know, companies whose share price are very sensitive to interest rates, either because they are in the business of lending and borrowing, or they are heavily dependent on EMI based selling. And if interest rates were to go up or down, their sales move a lot. So these are sectors I will trade. My strategy of theta decay on interest rate sensitive stocks will remain in place, and so will theta decay on oil and gas. I might cut down turnover sharply though, but the strategy remains in place. I don't believe the Gulf War will either extend too long, or if it does extend longer, I don't think it will continue to worry the international markets for too long. Similarly, there are concerns and valid concerns over Iran blockading the Gulf of Hormuz. Why is the Gulf of Hormuz so important? It is through this Gulf that 1/3 of all international natural gas exports are transported. Almost 20 to 25% of all crude oil exports are transported through the Gulf of Hormuz. In the past, Iran has used its navy and also laid underwater mines to basically stop the shipping lanes in the Gulf of Hormuz and try to put a full stop to exports from here in times of geopolitical tensions. Now, the remedy is that international coalitions led by the US have sent their naval warships and disabled those mines. They've challenged the Iranian vessels and ensured that oil exports continue. But the problem is that this adds on to the cost. And the first thing that will go up if there is any signs of blockades in the Gulf of Hormuz is insurance cost of those tankers will go up, which means oil prices might be driven higher. You've already seen that last week. Oil prices almost went to $76. I'm talking of the Western Texas Intermediate or WTI light sweet American crude. The Brent crude, of course, went higher. So in the near term, you might see inflationary worries which will drag the markets lower, but I don't expect that to extend too long. Empirical evidence or historical evidence is against it. Wars in the Gulf are not prolonged in nature. Where bullion is concerned, I expect bullion to get bought into on declines. Would there be declines? Yes, possibly. There is a special video coming up on what your strategy should be if bullion, which is gold and silver, were to decline. It's a very detailed strategy. Do stand by for this video. Where metals are concerned, they may see limited upside as compared to the last week or 10 days because markets were extremely jumpy in the last couple of trading sessions. That jumpiness may or may not occur, barring cataclysmic events in the Gaza war. Now, the fog of war, it is called the fog of war because clarity is missing. In the near term, there might be a fog of war, but I don't think over a period of time this fog of war will remain. So metal mining stocks may be relatively less nervous and less volatile as compared to the previous week, where the coming week is concerned. Now, if the war is to escalate, what should be your trading and investment strategy? What if the war is to escalate or if it is to prolong? Which sectors, which stocks will basically feel the heat? The first and obvious one is banks and interest rate sensitives, because inflation will go up. I just explained to you the insurance and transport cost of oil will go up. And oil, as I have been telling you over the last couple of years, is a multiplier commodity. Increase the price of oil and everything from fruits, vegetables to your milk, eggs, meats, grains, pulses, everything goes up, right? So higher inflation would mean lesser savings, and therefore banks and interest rate sensitive stocks could take a mild heat. Merchandise exporters stocks, especially to Iran and or the Gulf. You know, we export a lot of stuff to the Gulf, food, medicines, etc., etc. Engineering exports too. So there will be some amount of concern, some amount of anxiety whether the payments for these exports will come on time, although these tend to be guaranteed by third parties, if at all there are letters of credits involved, which invariably should be. But wartime delays and what is known as force majeure, inability to comply with a contract, may be enforced during the fog of war. So these concerns might hit merchandise exporters who are exporting to the Gulf. Petro-based raw material importers. Now, petroleum gives you a lot of raw material. Epoxy-based resins, which are used for adhesives, all right? Now, they are imported and from petroleum-based, their prices will go up, as will pigments, dyes, paints, plastics, polymers, certain medical compounds, medical raw material, pharmaceutical raw material. So these are company stocks that might face a little bit of heat in the case of extension of the war. Fertilizer, especially nitrogen-based fertilizers, which use up to 90% of natural gas as their raw material. Their price can go up. Now, what happens if fertilizer prices go up? The input cost of the farmer goes up. If the input cost of the farmer goes up because of fertilizer, because oil prices are up, so diesel and petrol become more expensive, electricity becomes more expensive, the farmer will want higher prices for his food cultivated, which means food inflation. Now, of all the types of food, all the types of inflations that I monitor, I consider food inflation to be the most dangerous. Why? Because the demand for food is inelastic. It is not negotiable. My stomach asks for food thrice a day, and I will want food thrice a day whether there's war or no war. So demand doesn't go down for food. If the price is going to go up and the demand is inelastic, people will pull out expenditure from other sources and spend more on food. That's logical. So stock prices of other sectors feel the heat when food prices go up. Transport and logistical companies' shares will also feel the heat because fuel prices will continue to go up in case the war extends. Travel and tourism. This is actually a no-brainer. I don't think anybody will want to have the guts to go out there and travel to Israel or to Saudi Arabia, Iran, Iraq, or Kuwait at this time. So obviously, people will be anxious about traveling. So travel and tourism industry stocks, especially destination Gulf, will see the heat in the near term. But over the long term, what? I repeat, Gulf wars are historically known to be short-term affairs. And besides, empirical evidence has taught us. I've traded these markets since the last 38 years, since 1986. I've seen Gulf War 1, Gulf War 2. I've seen 9/11. I've seen the war in Afghanistan in 2003 post 9/11. I've seen the war in Iraq. I've seen Myanmar. I've seen Chechnya, right? If you were to hold on to your long positions and even buy blue chip companies during the fog of war. Fog of war is anxiety, nervousness, pessimism, and falling prices. If you were to buy during the fog of war and be patient about it, you stand to make substantial gains. What about the fears of nuclear war? Well, if the nuclear war is to start, I don't think humanity will survive. Nor will your stockbroker remain alive to ask you for mark-to-market losses. So don't worry at all. There's no need for concern. Nobody's going to live at all, right? Yes, you should be allocating a little more to bullion, which I have been telling you in these videos. I'm very bullish on bullion since years. So continue and do remember, ships are safest in the harbor, but that's not what they are made for. They are made to go out in the sea, face the storms and reach their destination. That's when the captain succeeds. You are the captain of your own ship. I hope you succeed too. Friends, before I sign out from this video, a reminder to subscribe to my YouTube channel if you haven't already subscribed it. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know how my videos help you become a better trader and what I can record in my future videos to help you trade even better. Also, please share my video with smart guys like yourselves, your friends, your family, your social media groups on platforms like WhatsApp, Twitter, Facebook, etc. so I can help reach out to a wider audience to trade even better. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.